Hey, my name is Michael Miller. I'm the Chief Investment Officer of Crewcial Partners. We are the investment advisor to the Community Foundation regarding their various investment pools. And I'm here today to give you a brief update on investment returns and a bit about the portfolio strategy and what we're seeing in the market climate today. So very good news on the investment return side, where the portfolio, the endowment portfolio for the foundation was up about 10% when all is said and done, thanks to rising public equity markets and quite a bit of success in the private asset portfolio as well. So we're very pleased with that. That has brought year-to-date performance through mid-July to up around 6 or 7% year-to-date. So there were some negative returns in the beginning of the year related to the military action in Iran, creating some market difficulties, but they were fairly short-lived for a variety of reasons. One of the biggest being that there's a really significant amount of enthusiasm for artificial intelligence, large language models in the market, and that's become a very complicated story, which we can also spend a second on, if that's okay. And now what I'd also like to talk about is the strategy. So the foundation strategy is very much long-term oriented. So we're not trying to predict what the markets will do in the short term. We're not focused on the level of interest rates or any of those nice things that actually have very significant impact but are hard to predict. So instead, we follow a very diversified strategy, and that really serves the foundation, all of you as fund holders, and the community at large, really well through thick and thin. And I think we've been through a period now of more than 10 years with really outsized returns for public equity markets, particularly here in the United States. And unfortunately, nothing lasts forever. And so there's a cyclicality to these things. And so we worry a lot about that. And one of the ways we address that is by allocating assets globally, doing a lot of things to diversify the portfolio so that no one problem can really create major problems for the portfolio overall. Unfortunately, what's happened in the markets today is there's so much enthusiasm for artificial intelligence. It's led to these, very, very large businesses like NVIDIA and Microsoft, et cetera, that are such huge businesses that they take up a lot of space in people's portfolios, which is fine when these stocks are doing well. It's very disconcerting when they're not. And so the foundation's had a very specific strategy of owning a lot of these names. We have index funds in the portfolio, but diversifying it more than the indices themselves. And that's how we're intending to protect the assets and protect your philanthropy, depending on whatever the markets do next. The artificial intelligence trade, let's call it for lack of a better word, but the popularity of chip makers in particular and some of the hyperscalers and other AI related names is really become quite extreme. And it's worrisome because it's built on a fundamental view that the future is very clear, i.e. the current winners in semiconductors and other areas are going to continue to be the winners, which may or may not be true, but we do know one thing, which is we don't know what the future holds. And I think that's the key point. And so we don't want to be too exposed to any of this. And as we sit here and record this, the market is starting to come to grips with the fact this might be very complicated. There's a lot of debt involved with the AI data center build out. There's a lot of controversy involved with the data centers themselves in terms of their impact on communities. And there's also a lot of uncertainty about exactly how trillions of dollars of expenditures for artificial intelligence are going to be recouped. Who's going to pay for that? So it's a lot of complexity. And one of the things I do want to assure all of you of is that the foundation portfolio is very much built to not be completely associated with all of this. There is some exposure, but it's modest. And a lot of the things that we own are tending to have stronger returns and really preserve capital very well at this time of considerable volatility. And we'll see what the future holds. Again, it's always unknown. But when people get a little too excited about things, that can be a harbinger of disappointment. And actually, on the other hand, when people get too pessimistic about markets, that's usually a sign that things are going to get better. So thank you very, very much for your attention. I'm very pleased to share these results with you and look forward to sharing future results with you. Thank you.